Why is it that the stock market, historically, tends to go up over long periods of time? Yet the average investor's personal account often barely keeps up with inflation. Or worse, loses money? We look at charts of the S&P 500, or global index funds, and we see a steady line moving upward to the right. It looks inevitable. It looks easy. You put money in, and 30 years later, you are wealthy. That is the theory. But the reality for most people in the United States and Europe is mathematically very different. There's a silent gap between the return of the investment and the return of the investor, and that gap is not caused by fees, or taxes, or inflation. It is caused by a fundamental misunderstanding of how math works. When emotions are involved, let's look at a typical scenario. Imagine a young professional. Let's call him James. James lives in a standard metropolitan city. Maybe Chicago. Maybe London. Maybe Berlin. He earns a respectable salary. On paper, he makes $70,000 a year. He feels successful. But the math of his life tells a different story. Before that money even hits his bank account, the government takes its share. Taxes, Social Security, national insurance. What lands in his account is significantly less. Then the lifestyle costs begin. Rent or a mortgage takes 30 to 40% of his net income. It's expensive, but he needs to live somewhere safe, somewhere close to work. Then comes the car payment. In the United States, the average new car payment is over $700 a month. In Europe, leasing culture is catching up. It's a depreciating asset that he is paying interest on. Then there are student loans, credit card minimums from a vacation he took last summer, and the general cost of existing in a modern society. By the end of the month, James has perhaps $300 to $500 left over. He knows he needs to invest. He knows he needs to build wealth. But because he has so little capital left, he feels a psychological pressure to make that money work hard. He cannot afford to wait 30 years for a boring 7% return. He needs to catch up. He needs that 500 to turn into 5,000 quickly. This is where the mathematical trap opens up. James doesn't buy the boring index fund. He buys the asset that is currently in the news. The tech stock that just doubled. The cryptocurrency that everyone is talking about at dinner parties. He buys it because it is going up. He buys it because he feels safe, following the herd. And then the math of loss strikes. Most people do not understand the asymmetry of percentages. If James invests $1,000 and the market drops 10%, he now has $900. To get back to his original $1,000, he needs an 11% gain. That doesn't seem too bad. But let's say the market drops 50%. This happens. It happened in 2000. It happened in 2008. If James loses 50% of his money, he now has $500. To get back to his original 1,000, he does not need a 50% gain. He needs a 100% gain. He has to double his money just to break even. This is the math that destroys portfolios. When an investment drops significantly, the climb back up is mathematically twice as hard as the fall down. But James is human. When his investment drops 50%, he doesn't think about the math. He feels pain. Psychologists call this loss aversion. The pain of losing money is psychologically twice as intense as the pleasure of gaining money. So what does James do at the bottom? When the news is bad, when the graphs are red, and when he has lost half his savings. He sells. He tells himself he is cutting his losses. He tells himself he will wait until things stabilize. He turns his paper loss into a permanent mathematical scar. He took a 50% hit, and by selling, he removed the possibility of the 100% recovery. He stays in cash. He waits. Eventually, the market recovers. It always does. It climbs back up. It passes his original entry point. The news becomes positive again. James feels safe again. So he buys back in. But he buys back in at a higher price than where he started. He sold low, and he bought high. He did the exact opposite of the golden rule of finance, not because he is stupid, but because he is human. This behavior creates what is known as the behavior gap over a 20-year period. While the S&P 500 might return an average of 9 or 10%, the average investor often returns less than 4-5%. They capture less than half of the market's return simply because they tried to time the market instead of just sitting in it. The financial system is designed to encourage this. The financial news networks need viewership. They need you to feel anxious. If they told you, buy a diversified portfolio and do nothing for 30 years, they would go out of business. They need to sell you a crisis today and a boom tomorrow. They need you to trade. Brokerages need you to trade because they make money on activity, or they sell your order flow. The entire industry is built to keep you moving, to keep you guessing, and to keep you emotional. But the math of wealth is incredibly boring. The investors who actually succeed, the ones who retire with millions in their accounts, are rarely the ones with the highest IQ. They are not the ones analyzing balance sheets on weekends. They are the ones with the best temperament. They understand that volatility is the price of admission. They know the market will drop 20%, 30%, maybe even 50%. They expect it. They have factored it into their math. When the market drops, they do not see it as a loss of wealth. They see it as a sale on future cash flows. They do not sell. They buy. Or even better, they do nothing. They have automated their financial lives to remove their own psychology from the equation. Let's go back to James. If James understood this math, he would change his approach. First, he would realize that trying to get rich quickly is the fastest way to stay poor. The math of a 50% loss is too brutal to risk on speculative assets. Second, he would stop looking at his portfolio as a scoreboard for his intelligence. It is not a game to be won this month. It is a storage facility for his future purchasing power. He would focus on the one variable he can actually control: his savings rate. You cannot control the market return. You cannot control inflation. You cannot control tax policy. But you can control how much of your income you do not spend. The gap between your income and your ego is where wealth is built. If James decided to keep his old car for another 5 years instead of upgrading, that is capital. If he decided to live in a slightly smaller apartment, that is capital. If he automated $500 a month into a low-cost index fund and then lost the password to his brokerage account, he would likely outperform 90% of professional traders. The math of success is simple, but it is not easy. It requires you to be rational. when everyone else is being emotional. It requires you to do nothing, when every instinct in your body is screaming at you to do something. Wealth is not a function of intelligence. It is a function of behavior. It is the ability to endure uncertainty without panicking. The market is a device for transferring money from the impatient to the patient. If you can understand the brutal math of loss, and if you can master your own psychology, you are already ahead of the vast majority of investors. Be boring, be consistent, and let the math work for you, not against you. If you found value in this perspective, consider subscribing for more rational analysis on money and mindset. I'll see you in the next one.